There are two types of FOMO traders that come into the markets. There are those that come in with a lack mindset and they start a trading session believing that there's not going to be anything available which aligns with their plan. So what they end up doing is just forcing trades that are outside of their trading plan. Then you have FOMO trader number 2. This is the trader that has taken a loss and wants to now revenge that loss. So their number one priority is not to actually recover the funds that they just lost on the previous trade. It's the lack mindset of them believing that there's not going to be anything available. So again, they will force trades. Both of these two have one thing in common. They trade outside of their trading plan. I'm going to show you on the charts from last week how there was 20% available on just one pair amongst all the different pairs that we trade. Let's go straight to the charts. Alright, so here we are on New Zealand dollar, Japanese yen, and what we'll do is just start on the 4 hour. I'm not going to go into all of the higher time frame, but one thing that we can see here is that we had this strong run up to the upside. Price then came back into this area. It looks like it tried to correct and now it's moving to the upside. So as of now, we're just going to concentrate on this leg that's moving to the upside here. Now just dropping down to the 1 hour. The new trading week started around about here, there or thereabouts. Okay, somewhere around here, the new trading week started. So all of this price action here is from last week. So now let's see how we can find entries that are going to remove that fear of missing out, knowing that there's always a trade. And there's no need to force it neither. Now we can see for the first half of the week, price just kind of messed around. All of this here, Monday through to Wednesday, coming into Thursday. And we just had this very large scoop. Now initially, price tried to react off this wick here. It tried to move up, it tried to form a correction and then failed and carried on pushing down. Now just dropping down to the 15, it's very difficult to understand where price is going to react from. And this is something that you don't need to force. You can just let the market come to you. But we can see here that we've got a point here, we've got another point here, and we've got another point here. Now any of these two, so this point or the one just beneath it, we can say that price reacted from it. So now I'm not just going to rely on the 15-minute time frame. I'm going to go to just to the 1 hour alone. Now we're coming towards the end of the week here and we can start to see this movement going to the upside. And even if I have a look at the 4 hour, this is where you get your confirmation from. So first we had this strong doji candle. It's got quite a large body, but the next candle after it was a very strong bullish close. And now we've retraced more than 50% of this bearish candle to the left. And now we can see that momentum really start to pick up. So if I just drop back down to the 1 hour, now this is where we start to look for those entries, because once we can confirm some kind of directional bias, and even when we look to the left, there's minimal resistance really. I mean, there's a few points here where price can possibly react from. I just mark these levels down just so I can manage trades a little bit better. So now if I just drop down to the 15-minute time frame, immediately you can start to see here that price has started to correct. And this is the first sign of prices actually holding to move to the upside. And if I just go down to the 5-minute and we look at this first trade right here, okay, so right here, and you can protect just beneath. Now in terms of management, you can say price could potentially react from the high here, or even just slightly above it. Now look, you've already up to this point got a minimum of a 3-to-1 trade. And even on the 1 hour, if I just zoom in on the 1 hour, you can see that there's a wick over here. So there's a possibility that price could react from here. If not, then we have another point just above. And if not, we have another point just higher than that. You don't need to go for home runs. For your management, if you just have in mind here that you have a target of coming up to fill that wick, and then you can manage the trade accordingly. And it doesn't need aggressive management neither. Now, if I just drop that down to the 15, so there's your first trade. It's actually running right now and it's moving into profit. There was no drawdown into this trade whatsoever. Okay, so now your trade is running in profit. You can see the momentum kicking in. You are starting to see those strong 1 hour closes on the way up, and this trade is still running in profit. So if I just drop back down to the 15, let's just mark this area out because this is our target. So now we can start to look at other trades that start to shape up here. Now, there are aggressive ones like this. So once you are already running around about 1.5 to 2% profit, there's another opportunity right here. Okay, so you can enter on the break of that structure. You can protect your stop just beneath. And now you'll be thinking to yourself, well, now this trade only offers a 1-to-1. However, there's nothing to suggest at this point that the trade is going to turn around at this area that we've marked out to the left. So the next one just above that is around about here. And if I just move this up, then for the second trade, okay, you have a 2.3, 2.4 to 1. But then you have an area which is slightly higher up. So now here we go. So now you're able to achieve a 3-to-1 up to the next high. And as you zoom out, you will also see that this high that we've marked aligns with this high to the left, just over here. Once you break this area, you can see, right, okay, well, we have another high to the left here as well. So anything can happen. Now you've got this trade 3-to-1. Maybe you close this, or maybe you left it open, okay? Now, assuming that you left this one open to the next high, and you run this one to the next high above, already you have a 4.5 to 1, and a 4.6 to 1. So you're looking at over 9% already just on these two trades. Okay, so now if we move higher up with price action, we see this low here that price has come into. If I just drop down to the 5-minute time frame, you can also see that you now have a third scaling. Okay, so at this point, if we are now seeing price come into this area, let's see how the other trades are performing. So the second trade is currently not even running 0.5%. However, the first trade is running 2.2. So if we add these together, 2.2 and a 0.3, then you have yourself 2.5% in profit already. Now, depending on how aggressive you want to go, you can go down to the 5-minute here. Now that you know that you already have profit running in the market, even if you were to play the third trade anywhere around here and just protect below, you can even start to get in tighter now. To the first high, you've got yourself a 1-to-1, and then to the next high, you've got a 2.8, and then to that next target zone that we mentioned, there's almost a 4-to-1. Okay, so as the trade moves on, now that price has actually broken through this area and it seems to be holding quite well, we can move this up to here to have a look at what else could be available. So if we just, again, look on the 15-minute time frame, we've got this bearish low test. I mean, ideally, a bullish low test would be better. But if we just zoom in on the 5-minute, you can see here that price is coming to this area. It's broken through here, and now we are starting to get that retrace. So even if you were to place an entry a few candles in just to get the confirmation that we are going to continue to the upside, and even if you were just to protect below, to the next high up, we've got almost a 1-to-1. And then there's a 2.2 to the next area, and then higher up we've got a 4.4. So now you're really starting to stack up those profits. Okay, moving on. So price is now correcting here. So it is showing that it's not going to respond as a reversal to this area on the left. So we can just delete this ray line off, and it is holding for continuation to the upside. So now you can start to look at slightly bigger structures. And you're noticing here that the higher price climbs, the larger the corrections that it's forming. I mean, even if you were to play an entry just on the break of that structure, and you can protect just beneath. Now, just go into that next area, you've got yourself a 1-to-1. And then as it currently stands, price did run up to 2.5, and now it's starting to pull back. Assuming that you played all of these trades to the top, I'm not saying all of these trades are easy to catch, because it doesn't just require exceptional technical analysis. You also need to be in a very good psychological state and have the confidence to execute according to your plan. So if we just have a look here, 7-to-1 plus the 4, so 11, add another 6, 18, 19, 20, 21, 22, add up the difference here, 23, and then even if you add this one here, 24%. And there's no need for you to scan any additional pairs whatsoever. I've kept this analysis very simple. I've just stuck to the lower time frame. However, I do like to look in between the 4-hour, the 1-hour, and then the lower time frames as well, just to understand that are these value areas being responded to in an upwards trend, or do we see some signs of a reversal? But the bottom line is for all FOMO traders that just fear missing out, there are so many trades, and this ran from Thursday through to Friday. So 1, 2, 3, 4, 5 trades in that time. Now, my trading volume is not very high. However, if I'm already in the trade and I am running profit and my risk exposure has been taken off the table, now I know I can afford to actually enter the trade. I can also go slightly higher risk, knowing that if it does pull back, then I have the previous trades that are running in profit as well. And what I say to all traders is have a look at some of the pairs on your watch list and do assess the previous week, because you'll notice that sometimes you do miss trades that are there and you're searching between different pairs. I mean, I've seen traders that when there's nothing else available, they'll go back to gold, or they'll start looking at the S&P 500. No, those trades are actually available on the pairs that you forecasted, and there's a reason that you did filter those out. If you do like this content, then do like, do subscribe, drop us a comment, and we also have a free Discord community where I break down the market every single morning. I'll drop the link in the description.